Hello class, welcome to our third podcast regarding depreciation from chapter 8. We picked up here again with leased vehicles. Remember that there was a limit for depreciation on luxury vehicles we talked about in part 2. This is a way of extending that limit to leased vehicles as taxpayers tried to avoid the limit by leasing instead of buying. Then, of course, the tax law had to change to penalize leasing as well if you get too expensive of a vehicle. So that's what this process is about. There's a table, as you see here, that shows how much should be included. When we mean included, that means it's included income, meaning reduce your deduction by that amount. The table is based on 100% of the year and 100% of business. Any fraction of the year, or if a car is used for only 70% of business, then you would have to adjust the amounts on the table for those percentages. All right, so your deduction is what you paid minus the inclusion amount. So an example, February 1st, 2018, 35.5 is the value in between here, $1,200. The inclusion amount for the first year is $36 for the whole year. We didn't lease it for the whole year, so we're going to have to adjust that. 11 lease payments, $13,200. Lease inclusion amount is $33,000. It's a portion of the $36,000, and so your deduction is what you paid minus the inclusion amount. Doesn't make a huge difference, but it is still a penalty, and the amount that is included goes up as the value of the car goes up. The second year, the same car, leased in 2018. Go to the second column, still the same value, so $79 is the inclusion amount. So calculation is the 12 payments minus the $79. That's your deduction on Schedule C. Now, this is going to be the primary place you're going to calculate depreciation. With bonus depreciation not applying to real property, this is where taxpayers are going to be depreciating more often than not, because most personal property between Section 179 or bonus is going to be depreciated all in 1 year, and so you're going to have very little of depreciation deductions on an ongoing basis. But real property still applies. 3 types of real property, and we're really only going to worry about 2. Residential real estate, 27.5. Non-residential is 39 years. That's how long you depreciate it for, according to the tax law. You don't get to choose. This has not been in place, but it could be in place of service before 93. Not too many assets, even real estate assets that are still in place that haven't changed ownership or something since 93. But if you do have that, you could be still dealing with 31.5 years. But almost everything is going to be 27.5 or 39. Residential, vacation homes, rental houses for where people rent them rather than businesses. Non-residential, office buildings, warehouses, that type of thing. Basically anything that's not residential. Now, mid-month is the convention. Remember, we already talked about mid-year. We talked about, or the half-year convention. We talked about the mid-quarter. All real estate uses the mid-month convention. That means it's deemed to be bought and sold in the middle of the month. So if it was bought on January 1st, we actually treat it as if it was bought on January 15th. So in the first year of depreciation, it is always a half a month. There is no such thing as a full month in depreciation calculations for real property in the first or last year. So example, $150,000 sells property in 2018. we have to calculate depreciation for this last year in 2018. We know how to do the depreciation for 27 and a half years, but then in 2018, it's treated as if sold on August 15th. That's January through July, that's 7 months, half of August, 7 and a half. Okay? This is with the 31 and a half. Again, the 3.5 months, okay? In the 2018, all January, February, March, and half of April, even though it was April 25th, treated as April 15th. And non-residential real property bought this year, 39 years, but because it's bought in June, it is treated as if it happened on June 15th. So that half month seems to be the biggest concern, slip up with students when it comes to calculating depreciation on real estate. Now, home office. We talked about home office, what that, how do we qualify that, and how it's reported. We did a Form 8829 in Chapter 7. It is non-residential real estate. So 39 years on the part of the house that is used for business. Alternative, 40 years for all real property. Intangible property, things that like patents and other intangible assets, not something that we physically can touch. If you create them as a business, you don't write them off. They'll become depreciated until someone else buys them. Okay? So what we're talking about is buying them from someone else. If you, as part of an acquisition, they are automatically with Section 197 intangibles. Doesn't matter what they are, all these qualify, and they are amortized over 15 years straight line. Nice simple way to do it. Okay, remember you do have to use part of the year, that sort of thing. Other intangibles are always 15 years, whether they're bought as part of a business or acquired separately, doesn't matter. If they're not Section 197, they're written over their useful life. So then you have some flexibility. You don't have the a rule to tell you what their useful life is. For instance, 2-year covenant cannot compete if not part of the acquisition of a business. Okay, amortized over the 2 years that it's going to last. They do specify that off-the-shelf computer software has a 36-month useful life. So, out of all the others, that's the one that the tax code decided to designate, give an absolute number.